Hello, I'm Rachel Jones for the Finance News Network. Joining me today from Centuria Metropolitan REIT is Acting Fund Manager Doug Hoskins. Doug, welcome to FNN.
Thanks, Rachel. It's great to be here.
So first up, Doug, could you give us an introduction to the fund?
The Centuria Metropolitan REIT, or CMA, is Australia's preeminent metropolitan REIT with total assets of $1 billion, a figure that has more than tripled since our inception. Our market capitalisation is just over $600 million, and we own and manage a portfolio of 19 quality assets around Australia, valued at $930.5 million.
And now to your 2018 results. What were the highlights?
CMA has had a great year. Not only did our portfolio grow by 52.3%, achieving $1 billion of total assets for the first time, but the fund was also included in the S&P ASX 300 index, a major milestone that has many positive flow-on effects, including added liquidity for unit holders. We've got 98.9% occupancy across our assets, the highest level since listing, and we've achieved a very strong return on equity of 14.9%. CMA is well positioned with its strong occupancy, a 4-year WALE, and gearing currently at 28.3%, which is well within our guidance range.
And Doug, what were the drivers of these results?
Well, it comes down to our in-house core competencies and expertise, not just owning high quality assets, but also delivering high quality asset management, which makes us a highly attractive landlord. Together, these result in strong tenant relationships and better tenant retention. At the same time, our transactions team continues its track record of finding value. We sold 3 Carlingford Road, Epping on Sydney's North Shore at a 27.2% premium to its November 2017 book value, and we entered into a contract to purchase 2 Kendall Street in Williams Landing, Victoria. We have seen recent market evidence in the Williams Landing precinct of rising market rents and further cap rate compression, both of which may create further value for our investors. Across the board, our core capitalisation rate for the portfolio on a like-for-like basis is 6.65%. We've been buying high at 7.1% and sold Carlingford Road at 5.25%, which is a substantial arbitrage.
And can you give us more detail about the portfolio and your approach?
FY18 was a year of strong leasing activity that has seen the Trust hit 100% occupancy in 4 of its 6 investment markets. Upon the completion of the purchase of 2 Kendall Street, Williams Landing, the REIT's income stream will be spread across approximately 185,000 square metres of lettable area. We continue to see demand for high quality metropolitan office assets, and through astute transactions, we've been able to continue to deliver value to unit holders. When we first listed the Trust, we promised to unlock value for investors, most recently demonstrated through the sale of 3 Carlingford Road, Epping. In addition, we continue to deliver on our earnings and distribution guidance.
And finally, Doug, what can we expect over the coming year?
Our focus through FY19 and beyond will be continuing to build Australia's preeminent metropolitan office REIT. The coming year will see us complete the acquisition of our Williams Landing property and settlement of 3 Carlingford Road, Epping. The Trust also anticipates divestment of the portfolio's industrial assets if market conditions are favourable, which would subsequently provide investors with a pure play, high quality metropolitan office portfolio. The industrial properties are quality, well located assets with excellent tenant covenants, and we anticipate keen interest from the market. We've also given distributable earnings guidance range of 18.3 to 18.5 CPU, with distributions of 18.1 CPU for FY19. The FY19 distribution forecast reflects a distribution yield of 7.3%. The earnings reflect the anticipated divestment of our industrial assets, which currently account for approximately 5% of the portfolio. We will redirect this capital when we identify value opportunities in the market.
Thanks, Doug, and congratulations on the results.
Thanks, Rachel. Thanks for your time.